Okay, I suggest we make a start, and if people join us late, then that's fine. So good morning, everyone, and thank you for joining us today. My name is Richard Barnwell, and I'm a partner within BDO's FS advisory practice. My focus is on governance, risk and conduct across the banking sector. Of most relevance to our session today, I've been working closely with our clients over the past months on the topics of B bills and C bills, and therefore hopefully have some useful insights to share. I thought it would be useful to recap on what we're planning to cover today. So to begin with, we'll spend some time reflecting on the story so far and lessons learned. We're then going to explore some of the key regulatory and conduct issues. And finally, we'll look ahead as to what all this may mean for lenders throughout 2021. So before I move into the detail, I did want to just touch on some housekeeping points. So Lauren, do you mind just moving to the housekeeping slide? Thank you. So I'm sure, like us, you're all getting used to Zoom calls and MS Teams meetings and probably are experts by now. But having said that, I just wanted to lay out some ground rules for everyone to observe so that we can help ensure that A, the technology remains stable, and B, the session runs as smoothly as possible. So can I ask that you keep your video turned off, and also please ensure you're muted at all times. If you would like to offer an opinion or ask questions, please feel free to use the Q&A box, which I'm sure you're sort of all familiar with on Zoom. So just type the questions in there as we go along, and obviously we'll make sure that we'll track in those and either pick them up as we're discussing if appropriate, or use some time at the end to flick back through to the questions that have been asked. If you do have any issues with audio or video as we work through the session, just let us know in the chat facility, and Lauren can try and help you. We have got some supporting slides which you'll be able to see on the screen, and obviously we're very happy to share those with you once the session is over. All right, so I suggest I move on now, and perhaps just introduce Stephen, who's going to cover the next session for us. So we're absolutely delighted to have Stephen Pegg with us today, covering the first part of our session. For those of you who don't know Stephen, he's the MD of Commercial Finance at UK Finance and has over 37 years of relevant industry experience. He's part of the UK Finance exec team, and has been very much at the fore of UK Finance's work on COVID-19 lending schemes. So who better to take us through where we are and some of the lessons learned. So Stephen, over to you.
Thank you very much, Richard, and good morning, everybody. I was slightly anxious because at 9:30, the latest statistics for the lending schemes were released, and I wasn't sure whether they were going to be on time, but literally as we were waiting to start, I managed to get them on my phone. So you are the first to know that we now have 1.6 million businesses that have had support through either Bounceback loans, C bills or CL bills, with nearly £74 billion worth of lending done. That is a hell of a lot, clearly, in now just under a year, and most of it in the space of about 9 to 10 months, when the peak of drawing on those loans took place in early summer. The impact on the SME lending market isn't, of course, limited to that. There is business as usual lending, extensions to working capital facilities, capital repayment holidays, and of course, on top of all of that, many SMEs will have built up deferred taxes, rent arrears, and had the benefit of furlough payments and other support in the meantime. The net effect of all of that is actually, and rather contrary to some of the commentary in the media, quite a liquid market in aggregate. So if you look at the growth in total outstanding debt over 2020, it's been about 25 to 26% amongst SME borrowers on loan and overdraft. And actually there's been something of a reduction of utilisation in other facilities that have been to a certain extent crowded out, particularly by Bounceback loans at the small business end, with invoice finance utilisation down to 44%. But nevertheless, that 25% net growth is very much more substantial than we've seen historically. And it does take the outstanding SME borrowing to about 213 billion, whereas it had been running fairly steadily at 168 billion up to the end of last year, or 2019, I should say. The flow of lending, of course, has been much more significant, and gross lending, according to the Bank of England stats to the end of December, was 104 compared with 57 the year before. And when you look at particular sectors, this is where it gets interesting, because it's fine to say in aggregate businesses are quite liquid and borrowing doesn't appear to have kind of ballooned quite as much as might have been expected. But there have been many businesses, especially the smaller ones, who had not been borrowers in the past, who borrowed for the first time. In construction, retail, food and accommodation, we've seen a doubling of lending and an increase in stock of more like 50% or more. So there's no doubt that the incidence of that lending will have led to some businesses being highly leveraged. If we look at survey data, and I always think that's an interesting take on expectations and attitudes amongst borrowers. 44% are now using external finance. That has gone up from a low of about 30%. And there's been a 25% increase in deposits. So, just as businesses have built up their borrowing to tide them over for low levels of income, they've also cut costs and built reserves. The expectation of the need for finance now, looking forward, is about 14% of businesses expecting to need additional borrowing. You go back a year or so and that was only 3%. So that is high, but the approval rates of those requests is also high, about 85% according to the latest detail. So Bounceback loans obviously have been the big game in town, a very standard product, unsecured for 6 years, maximum of 25% or £50,000, whichever is the lower, self-certified for credit and eligibility. Fraud checks have been undertaken, contrary to many claims. It's been more straightforward, clearly, for existing customers, which explains the challenge for new customer acquisition and why many lenders have chosen to either suspend for a period, mainly reopened now, or suffered delays, which continue to a certain extent in new account opening. 90% of Bounceback loans were to micros. And of course, we've got pay as you grow now, which will start to kick in from the end of the first year, where there was a late change at our request to enable businesses to take a further 6 months payment deferral, I think, which could be particularly important for those hospitality businesses which borrowed in the very early stages and still aren't unlocked properly. Capital repayment holidays, 3 in a row, extension of term up to 10 years. Important to stress that CBILS is rather different, and there aren't those same product variants as such, albeit that forbearance is possible in terms of extending the term where that's really needed and can be proved to be affordable. So the NAO are expecting there to be a 35 to 60% default rate. That was what they reported. I think we should see the benefits of pay as you grow helping to mitigate that to a certain degree, or at least phase it over a longer period of time. So there is a degree of uncertainty. We've been working hard with across the industry to ensure that as far as we can, given that uncertainty, there's going to be capacity in the system to handle the customer support, that we can balance compliance with rules and regulations, which we try to align as far as possible with the need for sympathetic and supportive customer treatment, and efficiency and good value for the taxpayer, because particularly at that bounce back end, of course, the money is being recovered on behalf of the taxpayer with 100% guarantee, and also ensure that it's done consistently. This is a very standard product, and therefore it makes sense that the industry takes a broadly consistent view of it. We've had a task force which worked on protocols for recoveries and fraud, which have been agreed, regulations aligned with that. We've advocated for the future of schemes, which should be more of a return, we hope, to a normal basis of complementing the commercial market and additionality rather than substituting for it, and a feasibility study of whether it makes sense to have a centralized utility or at least a common approach. I think there's been a lot of learning through that process. It's likely to be a looser, more common approach, which we're still discussing across the industry at the moment, rather than something very formal and centralized. But nevertheless, I think some of the work that's been done will carry over in the way in which lenders work with debt collection agents. For the future, I think we'll have a lot of work to do in standing up the successor scheme, monitoring and reviewing collections and recoveries, continuing with the fraud working group, which has put in a lot of protections and controls on the risk of fraud. And I think importantly, enriching the data, not just to put so much emphasis on how much is going out the door, but rather what's happening with helping and supporting customers through financial difficulty. And then getting on to the important subject, which has been slightly kicked into the long grass, of growth finance for those businesses that now are perhaps looking to borrow and to grow and drive our recovery. And of course, alongside all of that, we're managing a changing picture in terms of the insolvency, corporate governance and tax framework, which is very much a reaction to the short-term needs, but also the desire for longer-term reform. Important to balance there the need for good access to finance. I will finish with a quick reminder that, of course, there's CBILS and CL bills. Important controls there on seniority and preference within the debt stack. And I think we all need to be thinking about restructuring and recovery and how all of that works with the future need for additional finance and indeed recapitalization for the slightly larger businesses in a scenario where balance sheets may be a little bit out of sync. But Richard, I'll leave it there and pass back to you.
Thanks, Stephen. That's incredibly insightful, and I think we'll sort of be building on some of those threads over the course of the next 20 minutes or so. So indeed, I wanted to personally spend the next 15 minutes talking through some of the regulatory challenges that we have seen firms face. In particular, I'm going to cover fraud and financial crime specific to the COVID-19 lending schemes. I was going to touch on collection and forbearance considerations as the loans start to fall due, which some of them are now. And finally, I thought the other thing that might be useful is just to talk about what we're seeing the IA function in the third line of defence do in relation to COVID-19 lending schemes. Can you move on to the next slide, Lauren? Perfect. And then the next one. Great. All right. So just on fraud and financial crime. So I'm sure you're all well aware of the press attention and regulatory scrutiny that this topic has attracted. Right from the start, it was highlighted that the risk of fraud associated with COVID-19 lending schemes is very high. and it would appear that these concerns have proven well-founded. Indeed, the National Crime Agency have said that they're working with the banking sector and other agencies to try and crack down on fraud related to these schemes. So I think that gives you an idea of how high profile all of this is. So broadly speaking, I think it's fair to say there's two key drivers of fraud with these schemes. I think firstly, the application process itself heavily relies on the information being provided by applicants and therefore is hugely susceptible to the provision of misleading information or failure to provide key information, which obviously causes problems. And I think secondly, and perhaps more cynically, the schemes have been targeted by organised crime groups that in effect have been incorporating fake companies solely for the purpose of obtaining loans under the schemes. And I think we've got some sort of anecdotal evidence that the number of new companies incorporated within Companies House doubled in the early months of the schemes, which I suppose could just be coincidence or could be suggesting that the issue is quite a serious one. All of this has led to a number of specific financial crime risks. I think the first I would sort of summarise as loan guarantees. So it's quite possible that the government will not guarantee defaults which relate to fraudulent applications. So obviously, you know, this puts quite a lot of pressure on lenders, and there's something pretty real and meaningful if you get it wrong and something does turn out to be fraudulent. I think a second one that's worth touching on is more broadly, there's an increased risk that either dormant, non-trading or already insolvent entities apply for a loan. I mean, and primarily what's going to drive that is the fact that a lot of firms are obviously applying for loans with perhaps banks or lenders that aren't their primary bank. And obviously in such instances where loans are provided, again, these may not be guaranteed by the government. And it follows that firms should be taking clear steps, I think, to substantiate trading history, identifying director bankruptcies and ensuring accurate affordability tests as part of that application process. I think the other obvious thing here is that there is an increased money laundering risk, which arises from repayments on both of the schemes being made using actually illicit funds. So, for example, launderers may well engage with a solvent firm and in effect sort of submit otherwise valid applications as a way of obtaining clean funds, which are then repaid using dirty money. And I think this is likely to be a particular risk where the lending bank is not the primary banker for the applicant. And again, in such scenarios, there's a real risk that the government guarantee element, where appropriate, becomes invalid. So I think clearly the message there is that it's important that lenders, you know, absolutely need to keep on top of this, not just at the application stage, but also during the repayment stage, to make sure that they do have and have had clearly established the source of wealth when carrying out their customer due diligence. And I think the final thing just to touch on here is the risks of persons applying for loans being named on national or international lists of terrorists, drug traffickers, criminals, or other persons wanted by authorities, you know, i.e. the sanctions type risk. And I think if such instances do arise, then there's absolutely going to be some potential reputational damage here for banks, you know, and therefore it's important that also that proper sanction screening is being implemented within that customer due diligence process. So I think just finally on financial crime, what I would say is that the overwhelming message here is that the COVID-19 related lending schemes do attract increased financial risks. And it's important, therefore, that firms are aware of these, have put in place appropriate mitigating roles and controls, and are in a position where they can evidence when challenged to the regulator that that's what they've done. And, you know, as I've just sort of touched on, I think the consequences of getting this wrong are far-reaching and may well lead to the loss of government guarantees on impacted loans. Okay, can we move on to the next slide, please, Lauren? So just on collections and recoveries sort of considerations, I think loans taken out in the spring of 2020 will potentially now be starting to fall due, and lenders will no doubt be contacting borrowers to remind them that payments will shortly be due and to outline their pay-as-you-grow options. We've already heard from Stephen the work that UK Finance have been doing with lenders to ensure a fair and consistent approach. Indeed, back in January, the FCA published its finalised guidance for lenders on the use of pay-as-you-grow options, and that guidance draws heavily on existing rules and guidance in Conc 7 and focuses in particular on the BBIL's borrowers. The first area that I wanted to touch on is forbearance and due consideration. As you would expect, this is a key area of focus for the FCA. There is acknowledgement by the FCA that the PAYG options in themselves do facilitate forbearance, but they also stress that these options on their own may not be sufficient for all customers or in all circumstances. So additional measures that we see some firms considering include suspending, reducing, waiving or cancelling further interest. So I think this may be appropriate where a customer is able to provide evidence of financial difficulties or cannot make repayments. I think it may also be appropriate on occasions to accept token payments for a reasonable period of time to allow customers to recover from specific unexpected shocks to their income. And I think it follows that firms should have in place clear and effective policies and procedures for dealing with and identifying such instances. One thing that we know a number of firms are doing is investing in automated online journeys that enable borrowers to access the different PAYG options before they fall into arrears. It's interesting that within that guidance that the FCA issued earlier in the year, they've stated that they're comfortable with that approach as long as any such journey incorporates additional forbearance options over and above those embedded within PAYG. So, there's definitely things that need to be thought about there. The next bit I wanted to touch on was around identifying and supporting customers in financial difficulties. So, as you would expect, there's some clear rhetoric from the FCA that firms should have in place appropriate policies and procedures for proactively identifying and communicating with customers who are falling in arrears. Now, within their guidance, the FCA specifically highlight that firms should consider getting in touch with a customer quickly after the first payment is missed on a loan. Now, again, the FCA seem open to parts of any related process being automated, but they are keen that this is not at the expense of bespoke conversations, which they feel, and I think it's probably pretty reasonable, will help ensure that appropriate forbearance and support options are being discussed and considered. We know that some firms are making use of filtering and triaging to better understand their customers' financial situation and therefore in turn identify those customers who are most likely to benefit from a bespoke conversation around forbearance options. And I think that approach is a sensible way of putting yourself as a firm in a strong position to evidence to the FCA that you are taking steps to ensure the fair treatment of customers. The other thing that's probably worth talking about is sort of your obligations as lenders to help customers make informed choices before selecting the pay-as-you-grow options. So helping customers to make informed choices is a key part, I think, of being able to demonstrate that firms are treating customers fairly and with due consideration. So again, I think some of the things that we're seeing out there is the use of personalised illustrations, which very clearly inform the impact of any changes in monthly payments to the overall total cost of the loan. We certainly see that as a critical tool. I think the ability for customers to discuss options with their lender is also key, and it's expected that this ability will be easily accessible alongside any automated journey. So I think going back to my earlier point, I think there is comfort from the regulator and an expectation that there's going to need to be a certain amount of automation, but it's important that customers do have the ability to actually speak to individuals where appropriate. I think similarly, where automated journeys are being utilised, there should be clear opt-outs for customers depending on their experience. So for example, if they are vulnerable or have specifically complex financial circumstances, it may be appropriate for them to not go through that automated journey. So just moving on to vulnerable customers, I mean, this isn't a new topic, and it's one that the FCA expects firms to have fully embedded throughout their culture, policies and processes. It's very likely that there will be customers who are vulnerable, I think in particular in that BBLS population. In particular, they may well have particularly low financial resilience given everything going on. Now, helpfully, the FCA guidance sets out a number of factors that firms should be considering in the context of vulnerable customers, namely how to identify vulnerable customer needs and the ease with which customers can disclose their needs. In some cases, customers may not recognise they are in vulnerable circumstances, or may indeed be reluctant to disclose those circumstances. You need to be making sure that you're providing communication channels that best meet those customer needs. And I think it needs to be clear to customers how they can use those communication channels, you know, including digital channels and other ways. The other point is around debt advice support. Now, again, I think there's an expectation that you are appropriately and proactively referring customers to get debt advice support where appropriate. And I think there's an assumption that for a number of customers who do find themselves in default or arrears, it's very likely that they will benefit from debt advice support. And again, I think the FCA have been quite prescriptive here in their guidance around what they're expecting firms to do. So, you know, there should be very clear signposts within any digital tools that you're using around the fact that there is debt advice support available. There's even a suggestion that you should be offering to transfer a customer's call directly to a debt advice provider, or provide the ability for the customer to access debt advice providers directly from your own website or mobile phone app or whatever other channel that the customer's using. I think consider whether the customer would benefit from a specialist source of debt advice, which may well be the case for example, a self-employed person or a person running a business. So I think plenty of food for thought there in relation to, I guess, some of the more specific conduct considerations that you should be thinking about. Okay, then finally, can we just move to the next slide, please, Lauren? So as you probably know, BDO act as co-sourced or fully outsourced internal auditors for a number of banks. And to this end, I thought it'd be worth spending just a few minutes on what we're seeing internal audit functions do with respect to COVID-19 related lending schemes. So we've already touched on the fact that the COVID-19 related lending schemes bring with them some risks and challenges, I think it's fair to say. The misinterpretation of scheme requirements, e.g. relating to eligibility, refinance and the government guarantee is obviously a key one. It follows that control weaknesses in the first and second lines of defence may well lead to unacceptable quality outcomes. And I think that gives rise to both conduct and credit risk. Another key risk here relates to the underlying data and IT systems, which I think in extremeness, if you're getting that wrong, could result in the lender being non-compliant with the schemes and therefore unable to make a claim on the guarantee that the relevant scheme offers, which obviously could lead to some significant financial loss. The other key risk that we discussed earlier relates to fraud and financial crime. Weakness in fraud risk management controls could result in an ability to prevent, detect and respond in a timely manner, again leading to potentially significant financial loss and indeed reputational damage. So what are we doing as internal auditors? Well, as you'd expect, there's been lots of testing. That is, after all, what internal auditors do. But more specifically, we've been looking at adherence to the British Business Bank and accredited lenders criteria and contracts. So, there's a whole adherence testing here in relation to eligibility. We've been looking and testing design effectiveness and operational effectiveness of the processes and key controls, including lender fraud controls put in place as a result of participating in the various schemes. We've been looking at the appropriateness of the systems and IT infrastructure that's in place to help ensure accurate implementation of the lending process. We've been looking at the pricing strategy to ensure that adequate proportion of the economic benefit has been passed on to the customer. And we've also been looking at the effectiveness of the controls put in place to ensure accuracy of customer data submitted to the required platforms. And finally, we've been looking at the effectiveness of the controls put in place by the business to ensure accuracy of the credit reference agency data that's being used for making lending decisions. If other approved lenders are not accurately and consistently recording COVID-19 lending scheme data in their submission files to various CRAs, then the customer's serviceability and debt status could be based on inaccurate data. So that's what we've been doing. Just moving forward, we're planning more work focused, I guess, on outcomes. So in particular, undertaking substantive testing of live cases where CBILS or BBILS have been used and provide proactive feedback on whether the lending criteria has actually been appropriately adhered to and evidenced. The other thing that we're doing is testing the integration of CBILS and BBILS data into core banking platforms, whilst also providing assurance over product classification and accurate reporting to the credit reference agencies within that submission file. The other thing to think about is reviewing the updates made to lending policies and procedures as a result of the new schemes, just to make sure that they have been updated appropriately. And finally, what we're putting on the list is reviewing the accuracy of the data in core banking systems by undertaking quite comprehensive reviews of the underlying records on the core banking platform versus that external reporting that's going to, for example, credit referencing agencies. Okay, so hopefully that's sort of a bit of a useful insight into what we've been doing with firms and what we see as some of the sort of the key challenges. I'm going to hand over to Kerry now, who's going to talk a little bit about what we can expect in the forthcoming year.
Thanks, Richard. Morning all. What I'd like to explore and talk around are some of the considerations for lenders during 2021 as we start to move towards a new normal for individuals and businesses, taking into account what happened in 2020 from a financial product perspective. Now, most of you are aware that one of the key aspects of the Bounceback loan schemes was that it removed the Regulatory and Consumer Credit Act requirements from loans for 25,000 and under for sole traders and other small businesses normally caught under these requirements. The coronavirus loan schemes were implemented to meet a unique set of circumstances, and as a result, there are a number of unique features of these schemes that will actually probably fall away with any new government schemes that are brought in. One of these that will most likely disappear is the current exclusion from the Consumer Credit Act and the requirements, or some of the requirements under the Consumer Credit Sourcebook (CONC). The fact that no affordability assessments under that there were no affordability assessments under the Bounceback schemes was a change not only for lenders themselves, but also those businesses applying for credit. In some cases, businesses were getting credit for the first time, so the experience they've actually had is very, very different to what it historically would have been. And by this, I mean normally they would have had to go through a proper affordability assessment, as well as potentially providing a lot more information about their business's financial and trading performance. Once the Bounceback schemes comes to an end and there is a move back to lender standard products or a new government scheme is introduced, This means that lenders will need to revisit their previous approaches to assessing business loans for £25,000 and under and decide whether the creditworthiness assessments they had are still actually fit for purpose to address the credit and affordability risks under CONC. The unprecedented impact of COVID-19 has meant that the information that lenders would have previously relied upon, including financial accounts and historic trading performance, may either no longer be readily available or might not provide a reliable picture of the potential performance of that particular business. The other consideration is the impact of the past year on credit files, especially for sole traders, and whether these can be used in the same way they historically have been. That's another consideration that lenders will need to work through and see whether it's going to work going forward. Alongside this, there may also need to be a re-education or realignment of borrowers' expectations when applying for business lending products. A prominent feature, and one that was highlighted by the media at the beginning of the Bounceback schemes, was the speed with which loans were meant to be processed and provided to borrowers. Going forward, though, business loans won't be provided in the same way or with the same speed. So part of the customer journey that lenders will need to consider is how to readjust borrowers' expectations about the information they'll need to provide at the beginning of the application process and how long applications will actually take to assess. This may also extend to providing training for frontline staff to support them in managing borrowers' expectations. Lenders will be familiar with the product governance requirements applicable to the launch of any new product into the market. But against the backdrop of COVID-19, lenders may need to pay special attention to how they articulate their target market, as well as what identified need they are seeking to address with their new product. By this I mean that 2020 saw a huge amount of lending take place under the government schemes, and as Stephen said earlier, based on today's figures, it's approximately 74 billion. And there are some that believe the market is now saturated with debt. Therefore, the design process around any new lending product may need to bear in mind this potential market saturation, or if this is thought not to be the case, what funding need has been identified for SMEs and how does this new product address that? With the amount of lending that has taken place over the past year and the uncertainty that still exists for many businesses, lenders should ensure that they have strong controls and governance around their product design processes and that there is a clear articulation of a product's target market and the niche requirements it is meeting. As I mentioned before, the potential market for SME lending has increased following 2020 as businesses took advantage of the government loan schemes where they may not have had exposure to external finance previously. But lockdown also saw a lot of people set up new businesses from home. So again, there are potential new customers within this space for lenders. Although lenders are used to dealing with new businesses, there may be more businesses than before who are having to deal with financial providers for the first time from a commercial perspective. These factors, such as limited experience to external or commercial finance, are issues that lenders should consider as part of their product design and governance process, and it may impact the application journey, explanation of fees and charges, and any customer communications throughout the lifetime of the product. As mentioned before, the FCA has had a greater focus and prominence on vulnerabilities, especially with their new finalised guidance issued earlier this week. And lenders may also need to consider a broader range of vulnerabilities within their product design journey and processes, more so than they ever have before. Good customer treatment and outcomes remains a key focus area for the FCA heading into 2021, especially where there are new product launches or product changes, and lenders have to ensure that they have strong controls and governance in place around these. The use of analytics and digital transformation in financial services is growing, with lenders leveraging technology and data to better understand businesses' performance. Even before COVID, some lenders were making the move to increasing rely on analytics to assess the financial health of SMEs. And now, where some of the standard data sets that lenders would have sought to rely on as part of their affordability process is no longer either available or reliable as they previously were, more lenders may make the move towards analytics. With any reliance on technology, lenders should ensure that they have robustly tested the system before going live with the information, but they should also ensure that any parameters they are using are regularly reviewed and assessed for the continued appropriateness and applicability. The last point I wanted to touch on looking ahead was forbearance. And as both Richard and Stephen have mentioned earlier, with the implementation of the pay-as-you-grow options under the Bounceback scheme, a number of lenders are making use of a digital journey given the volume of borrowers they may be working with now. Some of the options under the pay-as-you-grow may not fully align to the standard types of forbearance measures lenders would traditionally offer SMEs for their normal lending products. So again, borrowers' expectations may need to be realigned either for the other existing products they have with lenders or any future lending they may choose to take out. The other consideration for lenders is the general treatment of customers going through the digital journey for bounce-back schemes versus those being offered forbearance under lender standard products and processes, and the ease with which those customers can access the forbearance options that may be available to them. There will invariably be differences between using a digital journey and a traditional in-person journey, but lenders should seek to minimise those as much as possible so that regardless of the product the customer has, they don't suffer any detriment. 2021 is different for everyone, not just lenders and borrowers, but lenders have never previously had a product as universal as bounce-back schemes. And as we gradually take steps away from this, it is something that lenders will need to bear in mind as they begin to interact with borrowers on different commercial and external finance products. Richard, I think that's back to you to close up and do Q&A. Thank you very much.
Okay, thanks, Kerry. So we've had quite a few questions in the Q&A box, and just a reminder, if you do have any questions yourselves, do put them in there now, because there's probably still a bit of time that we have to go through them. So I think the first actually is probably one for you, Stephen, which is quite a general question, but I'd be interested to get your thoughts on it. And it's simply, do we think that the schemes have been successful?
Yeah, I mean, I think as the National Audit Office report observed, you know, the key policy criteria and KPIs for measuring this would, sorry to put my video on now, were not kind of set out in huge amounts of detail at the beginning, you know, given the pace at which this work ought to have been introduced. But you know, I'd say there were three broad objectives. The first one was provide immediate liquidity injection to reduce the risk of major insolvency and an increase in unemployment in that kind of initial shock. And I think there's no question that that worked. We've seen actually insolvency lower than it had otherwise been. You know, the take up of this and the net result of liquidity in the market has been very successful in you know, maintaining economic activity. You know, employees may be on furlough, but nevertheless are available, I think, for restart as required. The second objective would have been providing time for adjustment and recovery and some funding to help businesses change their operating models. And I think we've seen reasonable evidence of that, you know, as many businesses have adjusted to home working, digital channels, in some cases changing their market focus. You know, I'd say that, you know, if you look at the impact on economic growth of this lockdown compared with the first one, it's very much lower, and businesses have improved their resilience through it. The third and final one is much less certain as yet, which is this good value for money for the taxpayer in the longer term? And what you saw in America as an alternative strategy was basically to provide you know, higher and more generous levels of unemployment insurance, and then help and encourage new businesses to start and businesses to kind of take on and grow. So you saw a spike in unemployment and then a recovery to a new norm rather than freezing things, which has been the approach in Europe. You know, we'll see which is the more successful strategy as things pull out. But I would say on balance, yes, it has been successful, but you know, it's had some consequences, particularly as I mentioned in crowding out the commercial market. Some players who were not able to participate in bounce back loans because, you know, the interest rates were too low, and the type of finance was not one that they provided. So it's important we get back to something which complements the market, enables invoice finance and many of the specialist forms of finance to play their full part.
Okay, thanks, Stephen. There's a couple of other related sort of questions that I've seen on the sort of the more conduct side of things. So one of them is around does the sort of when does the debt collection Conc 7 sort of stuff that I went through actually apply? Is it just for sole traders who've borrowed 25,000 or less. I mean, my understanding there is, strictly speaking, yes, that's right. It would only sort of bite on that smaller end of the market. Stephen, anything to add there?
There were some adjustments in general that applied to C-bills and the standards of lending practice, in addition to the changes to disapply elements of CONC. And it's important to note those that there are still expectations around recoveries. It is mainly the underwriting approach, in particular testing of affordability, and that did apply to a certain extent to CBILS as well, in that the major banks with government approval and with regulator acknowledgement were not insisting upon a substantial amount of work being done around cash flow forecasts, for instance, in a very uncertain period of time, just relying on track record before the crisis and more general portfolio level information. But by and large, it is that kind of smaller end, the CCA element, which has been the most significant element of regulatory forbearance.
I mean, I think the message here is always, as lenders, you should be doing the right thing for your customers, irrespective of where they sit on that scale of sort of small, medium or large, which I'm sure most of you are. I mean, clearly at that smaller end, there are more prescriptive things that you need to be doing. But I think we're all well aware that when the chips are down, the FCA and the PRA and government themselves, sort of under political and media pressure, can sometimes kind of focus on some of the grey areas. So I think, if you want to be putting yourselves in as strong a position as possible, you need to be applying good, sensible practice across the piece. I mean, and actually, I think there's another question that's come in around, what's our advice on the proactive identification of vulnerable customers in the sort of the SME, small consumer business type area. And I think, a bit like the point I've just made, whilst it's easy to think about vulnerable customers more in that consumer end, and indeed that's where the vast sort of thrust of the FCA's focus is, you will still get vulnerable customers who are running a small business or in that SME market. I do think it's important that you have developed policies and procedures that enable yourselves to demonstrate that you're asking the right questions and doing the right things. Because, if we fast forward this 12 to 18 months, it's quite feasible that there is something in the Daily Mail around how loads of SMEs have been hard done by because, this hasn't potentially been administered properly. So, yeah, I think it's important to really feel that you're in a position where you can look yourself in the mirror and ultimately withstand sort of regulatory scrutiny that will inevitably come. I mean, I don't know if you agree with that, Steve. I mean, it's sort of my thoughts rather than...
Absolutely. There are clear expectations and guidance that's been put out by the FCA, and we saw a further publication in the last 48 hours around that, which is principally about individuals, but does kind of lap into sole traders. But even before that, we've had extensive conversations with the FCA around particular and extra requirements for customers in vulnerable circumstances, in all sizes of business. And just because it's a larger limited company, if there are key people involved who are in those situations, then that needs to come into the way in which those customers are dealt with. I would just say, however, that there is also an acknowledgement that we're talking about a very large volume of loans, particularly in the case of Bounceback loans, and that a degree of automation is the main way in which customers will be handled, with the opportunity to kind of break out and deal with those customers on a more bespoke basis where that's justified. And also pay-as-you-grow options provide what is very generous forbearance in reality. So, you know, there may be bespoke needs and additional forbearance in some circumstances, but I'd expect that to be relatively limited given the generosity of pay as you grow.
Okay, perhaps time for just one more question. So I've had a question around what are we actually finding in our IA work? So I took you through sort of some of the stuff that we're doing. Well, I mean, it's a mixed bag. I think, you know, by and large, I would say that the vast majority of the firms that at least we deal with are in pretty good shape on this. You know, and they've certainly set out to try and do the right thing. I think by and large they are. I think inevitably, and it always happens in particular when something's new and obviously it's had to be implemented at pace, I think firms' ability to demonstrate and evidence exactly what they're doing is sometimes quite patchy. And I think that probably manifests itself in two ways. You know, one is around the actual documentation that as internal auditors you want to see and you want to look at, and the quality of that, and whether indeed it's even been sort of changed appropriately, is something where I think some firms are having to do a bit of sort of reverse engineering and catching up. I think the other thing, which tends to be better, but sometimes isn't always there, is being able to evidence at a more senior level from a sort of a governance perspective that these things have been appropriately discussed, and that the reason and rationale for certain decisions is clear, and can be evidenced. And I think that tends to be better, because I think firms, especially in the sort of SMCR world, appreciate how important that is. But I do think some of the work that we've done has sort of highlighted some gaps there. And you know, it all sounds pedantic, but of course this is what internal auditors do, and ultimately they, you know, apply the same sort of lens that the FCA or the PRA would when looking at this. And you know, I suppose the lesson there and the thing that I would underline is, you know, just make sure that there are and is appropriate audit trails in place around this, that you've got good MI, that you're able to fully evidence and justify the approach that you've taken and why. And I think, you know, there will be things that inevitably firms get wrong. But I think if you've got that audit trail, and in particular, if you're able to evidence how it's been discussed at a very senior level, that puts you in a good position with the regulator.
Richard, I'll just add, and this is a long and slightly eye-watering list. We had to try and align a lot of different kind of key regulators and stakeholders with these kind of requirements. I mean, you start from, I suppose, the existing legislation, and we've already talked about the changes that were made to accommodate bounce-back loans through CCA. Then you have the rules of the schemes set out in the contracts and the lender agreements and the guidance notes that go alongside them from British Business Bank. There's then the expectations of Treasury and government more generally, and on fraud there's the interest of BEIS and Cabinet Office and others who you know, are involved in this, and the people that scrutinise them, including the Treasury Select Committee, as well as the FCA, the PRA are involved as well. You know, in terms of the general responsibilities of senior managers, as you've discussed. And in fact, we have a meeting tomorrow as our regular catch up with FCA and PRA join that as well. The Lending Standards Board I've talked about, and you know, where there are invoice finance facilities, we have a Professional Standards Council for the regulatory framework, the standards framework there. And then there are the dispute management elements, and we've written and had exchanges of letters with the FOS, and now the Business Banking Resolution Service launched last week, which you know, will not look at bounce-back loans, but may be involved in complaints around CBILS. So you know, there are a lot of parties here, And this has been a moving feast as we've developed new proposals around pay as you grow and so on, top up loans, and with the successor schemes and how they all interact. So it's a very complicated thing. And then reputationally, of course, you have the media, individual politicians, the stakeholders. So we have weekly calls with all of the business groups. Kerry worked with us for quite a while and during all this, and recognises the kind of complexity of managing that. But that's also a consideration for firms, I would say, just managing those different stakeholders insofar as you have that interaction to ensure a consistent kind of view, because the last thing you want to fall into is regulatory conflict here, where you kind of satisfy one and fail to satisfy another. Sorry to end on a slightly kind of challenging note there, but I think on balance, the industry have done very, very well in doing that so far. And I think, the reputation stands in a good place, but we're about to enter a tougher period.
Yeah, I mean, and I think that's my feeling too. And I suppose my concern is that, there are no own goals scored, as it were, by kind of just not doing some of the simple things that perhaps the lenders need to do to protect themselves from that inevitable scrutiny that's going to happen. Because I think it would be a shame, because as you say, I think the industry's really done a great job here. Okay, well, that's almost perfect timing. So thanks, Stephen, very much for your time and input. Thanks, Kerry, too. That was really helpful. And thanks to everyone that joined today. Hopefully you found that useful. Obviously, if there are things that spring to mind after this, then do get in touch. We're very, very happy to help.
Thank you.
Thanks, everyone.
Thank you.